Welcome back to the learning curve. Today we're going to stick to one tool, one metric called the Mayer multiple, and it's going to help us understand what happens at cycle tops, cycle bottoms, and we're going to get a better understanding of the metric on its own and how to use it. Remember, this is not financial advice, and here at the learning curve, subscribe, like, and comment below. And please do read further into the channels that I highlight, the people that I recommend, so that you get a better understanding of the market and you're not just hearing my voice, but you're getting a well-rounded understanding of how other people are thinking in the market as well. Remember again, this is an educational channel, and without further ado, let's go into it. So, the Mayer multiple, here we have it in red on the side, how extended it gets, and then we have it here correlating to the price that we can see, which is this rainbow line going up and down. So what does the Mayer multiple do? It looks at the 200-day average of the Bitcoin price, and it tells us how the current price compares to the average of the last 200 days. And why do we look at the 200-day average? Well, in many assets and in many equities, people tend to look at the 200-day as psychologically look at the last 200 days to gauge what the current price is and how it's comparing to the past. So we can see that when the current price gets overextended and you get these high peaks, so multiples of the last 200 days, psychologically we're looking 200 days back to see how we're doing and comparing the present to see whether at the moment we're overextended, like we can see here, or whether we're sort of going into lower zones and we're sort of underextended and potentially looking at market bottoms. But psychologically, humans tend to look at this 200-day window. It works in other assets. It's a sensible. It's so sensible to bring it to the Bitcoin sphere and compare it and use it within the Bitcoin ecosystem. So as we can see in the last cycle highs that we've had here, we always get these big red deviations towards the upper side, indicating that there's sort of exuberance, the price is many multiples above the last 200-day average, and its potential at top. We have a mid-cycle correction here where we had a high to the 2.4 level, but on the whole, over the history of Bitcoin, in the recent history, we see a downtrend, and also in the sort of extended life of Bitcoin, we can see that there's sort of a downtrend in how high the multiple is going above the 200-day average, so how high the Mayer multiple is going. Let's look at it in a different way. So Trace Mayer, the gentleman who created this metric, did a sort of historical analysis of it, and he found that a level of 2.4 indicates that the market is overheated, and he would recommend sort of not buying more, not entering more here, and waiting for it to cool down before re-entering the market. And as you can see, it's held up pretty well so far, and in 2021 was the last time we hit it, which was the cycle top. And again here, we're not quite there yet. So based off of this old 2.4 metric, we're seeing that potentially we're not at a top at the moment. But it is important to notice that the level at which this Mayer multiple is hitting each successive cycle top, so this is a little bit lower. So we've got the 2017 cycle here, the 2021, the mid-cycle top in between these two halving cycle peaks. And now at the moment, as we're approaching this cycle here, we have an extended area, but we're not reaching that level. Perhaps if we follow this trend down, we're at the top now, we're a mid-cycle correction, but we're not at the exuberant level that we previously have seen, or that is marked by the 2.4 level. Actually, to be precise, we're at sort of 1.3-ish at the moment. Another way to look at the Mayer multiple is to split it into bands and say, hey, if we're in the deep green, we're oversold. If we're in the light green, we're bearish. Yellow is sort of bullish territory, and we get a bullish overextension and overbought. So this Mayer multiple bands are calculated using the overbought of 2.5, so close to that 2.4 level, and less than 0.55 is oversold. And then we start thinking about we're entering the bullish overextension at above 1.7. So 1.7 bullish overextension, 2.5 overbought. And as we can see, when we hit these dark green areas, we are sort of at cycle lows, and it's a really good time to start accumulating for the future, or it has been historically. And when we hit these, let's look at these cycle tops. When we go above the red or we hit the red, we start being in these overextended, whereas it's not going to generally stay much longer, or price isn't going to stay much longer in these levels, and it sort of zigzags on its way up to these levels. Let's look at other cycles. So in 2017, we bounce around up and down in this bullish overextension zone, and then we pierce up into the overbought and come back down. So the overbought generally doesn't last long, and we had a mid-cycle correction where we just about touched it, and also in the last 2021 cycle, again, we go up, we pierced it once, we pierced it twice, but the total number of days in this zone aren't very high. And sort of looking back, or in hindsight, it would have been good to sort of take some profit in these levels in the overbought area, as we know that the price just eventually came to sort of about half of what it was. So you got about a 50% correction. So it's a good metric in that sense so far. And it definitely seems to be quite good at marking the bottoms. And if we look at the moment, comparing these bands, we're starting to hit the bullish overextension, but we haven't hit the overbought. Perhaps we don't hit it, but but if we do hit it, it would be a sort of something to start considering, starting to look at other tools to see whether we're reaching the top or whether we are at the top. Another great channel to follow is Check on Chain. Please do look at their YouTube channel. It has lots of good data. But they have a similar thing. For the green, sort of where you want to start accumulating heavily below, as you can see here, the green dots marked here, is below 0.8, not the 0.55 shown previously. And the top here is again 2.4. So if you start hitting the 2.4, 2.5 levels, again, we can see the price here. It is overextended in these levels here. But again, notice that it has been coming down. So potentially we might, if we follow this trend line, it roughly correlates to about a sort of a level of 2-ish, 2.1, I think. So it is important to bear that in mind, that we might not necessarily hit the overextended. We might do, but don't be surprised if we don't, if we follow this trend coming down. However, we are zigzagging up towards the 1.5 level. Previously in the other chart it was 1.7. So we might notice a bit of zigzagging as we go further up. Right now it doesn't seem too overextended. However, if we're comparing this to the 2019 mid-cycle correction, this could say that this could, or fits in the diagonal sort of trend line down to indicate that we might be at a mid-cycle correction here. We might have a little bit of selling over the next few months as we sort of build up another base and then go for the full overextended target to try and reach it. Now, why do we get these little marks here? What determines what level is appropriate or that we should be focusing on? So if we look at sort of the Mayer multiple distribution, and we're looking at the sort of the daily frequency, how many days is the Mayer multiple in these levels? If we hit the 2.5, 96% of the time it's generally lower. It's only higher about 4% of the total days. The metric is higher. So if you're looking at a sort of, I think they use the 2.4 level actually. If you're looking at the 2.4 level, still 96%, the metric isn't going to stay many days above that level. So if you're playing a risk reward kind of setup, you're thinking 96% of the time the metric is lower. That means the price is going to have to come down or stay at the same level it is for the metric to come down. So it is indicating a sort of oversold area, and it's not going to stay at this level for much longer. And realistically, it's going to go back towards the median of the distribution over here, which I think is I'll have to double check, but I assume that this darker one is the sort of the middle zone. But again, the 2.4 is indicating that the market isn't going to sustain this level of the Mayer multiple for much longer, or the times it does is very few amount of days. And we also had the 1.5 and the 1.7, and again, the 1.7 is showing that 86%, 1.5 is showing 80%. So generally speaking, the majority of the time during the market cycle, the Mayer multiple is going to be lower. So when you start reaching these levels, you're not going to stay at these levels for a long time. So this is 20% more days is going to stay higher on average, and the 2.4 is 4% of days are going to be higher in this level. So it's generally pointing at these aren't sustainable levels when you're getting to the 2.4, and a little bit more sustainable, still not hugely sustainable at 1.5. Now, as you've seen in the last metrics, the Mayer multiple over time tends to have lower peaks. So what Willy Woo has done, if you go to his channel or his YouTube, is Woonomic, is a good on-chain data analyst. He's looked at the Mayer multiple ranges over the last 4 years, made an average, and looked at the standard deviation of that Mayer multiple over the last 4 years. So while his data has a more recent data bias, it takes out that sort of general decline that we used to see in the old spikes, and he puts and he uses a 2 standard deviation to indicate a cycle top. So he's played around with the statistics, but essentially, again, what his market Mayer multiple tool is showing is that we're not at the overheated levels yet, and this is sort of meant to be corrected for over the last 4 years, the more recent Mayer multiple data. And so this is comforting that it's sort of collaborating with the previous Mayer multiple models, showing that we're not really at the oversold area. We're at a sort of maybe 0.6, 0.5 level of a standard deviation. So we still got plenty of room to go up higher compared to the 200-day average. More reading, or to get some more understanding of the actual tool itself, please follow Trace Mayer and look at his work. He'd actually developed this tool. And please do look at the other people that I've commented in this video to get some better understanding of the market, because this channel is all about learning, it's all about informing you, but also pointing you to other resources so you can get sort of a better understanding of Bitcoin, its cycle, and how it works, and how to notice a top and a bottom, and how to potentially think about investing. But then again, not financial advice. I hope you learned a lot. If you have any questions or want to learn about different tools or want me to cover different areas, then please do pop a comment, or if you have any questions about this tool, pop a comment and I'll try and get back to you. And otherwise, like and subscribe